Gold is no longer a pet rock or a barbarous relic or the things of sensationalism. It is the reserve asset of the world. It's got a tier one status. It's being used in net settle oil trades. It's being used in net settle BRICS trades. It could even become a BRICS currency. It doesn't matter. It will always be a net settlement trade because it is trusted more than any other fiat currency, including the world reserve currency. These are not sensational facts anymore. You don't need to put on a tinfoil hat, argue about Bitcoin versus gold, or argue about the US dollar versus gold, whether you're middle class or lower class. If you can't afford an ounce, a half an ounce of gold, if it takes you time, it's going to be a better savings asset than your portfolio, than your IRA or your checking or savings account.
According to the International Monetary Fund, the US dollar has gradually declined as a share of global foreign exchange reserves over the past 23 years. Gold holdings, valued at market prices, account for 15% of global reserves. Consequently, the US dollar share of total global reserves, including gold, would fall to 48.2% instead of 54.8% of global foreign exchange reserves. Once gold breaks out against the 60-40 portfolio and silver makes a new all-time high, the current secular bull market will fully align with the one seen in the 1970s. This setup may provide an opportunity for spectacular gains in precious metals over the course of 3 to 4 years. The potential gains should surpass those seen in the 2000s, from 2005 to 2007 and 2008 to 2011. Renowned analyst MatthewPiepenburg emphasizes that gold is no longer seen as a pet rock, but has become the world's trusted reserve asset. He notes that 2022 sanctions eroded the dollar's status as a neutral reserve, decreasing global demand for dollars and treasuries. As to how rates would spike to 8%, there has long been a fear that foreign countries could dump their holdings of U.S. treasuries all at once, sparking an imbalance in supply and demand and sending interest rates soaring. Regarding the shift in global trust, Matthew explains that BRICS expansion and more nations trading outside the U.S. dollar further highlight declining demand for the dollar as a reserve currency. The shift from dollars has also been pronounced in countries concerned about U.S. financial sanctions, like Russia and China, and dollar hegemony. Such central banks have also increased their holdings of gold, though gold remains a small percentage, about 10%, of overall central bank reserves. In his assessment, Matthew explains that nations are repatriating gold and avoiding Western exchanges like COMEX, weakening these institutions' control over gold prices. According to him, the rise of the Shanghai Gold Exchange and the increasing trade outside of the U.S. petrodollar are clear signs that global financial dynamics are shifting away from the U.S. dollar's dominance. Now, we present the clips of MatthewPiepenburg's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The U.S. dollar and the U.S. IOU, the U.S. Treasury, simply is not as trusted as much today as it was yesterday. And there are a number of reasons for that. I think one of the most obvious is just the fact that the U.S. is a declining asset. The U.S. Treasury is a declining asset issued by an increasingly indebted nation. Issuer. The U.S., again, we've talked about, is no longer the nostalgic, iconic U.S. with the flag on Iwo Jima or Clark Gable in the Hollywood and these great iconic kind of images and strengths of post-World War II America. That's a wonderful image. It's a nostalgic image. But fast forward to where we are today, it's not the reputation the U.S. has at home and certainly not abroad. Here in Europe, we are not respected for our domestic policy, our fiscal policy, regardless of what you think of our foreign policy and our series of direct or indirect wars. If you just look at America financially, it's not as respected. And the evidence of that is literally everywhere. Andy Schectman, who you know very well, has talked about this brilliantly. I'm completely on the same page. The most obvious sign of that, I think, is the weaponization of the dollar back in 2022. Whatever you think of American foreign policy, Putin, Zelensky, again, it's not here to talk about, but when we weaponize a neutral reserve asset like the dollar, the rest of the world distrusted that asset, demanded that asset less. When there's less demand, that asset, that dollar, that treasury becomes less loved, less demanded, less powerful. The evidence of that in Europe, right here in Switzerland, where I work, is the Bank of International. It's not a coincidence in 2023 that the Bank of International Settlements described the U.S. Described physical gold as a tier one asset. The only other tier one asset that the BIS recognized until that point was the sacred cow, the 10-year U.S. Treasury, the U.S. bond. But that bond is not respected or trusted as much post 2022 as it is today. So as it was before that. So that genie never goes back in the bottle. You weaponize a currency, the IOU of that weaponized country becomes less loved and less trusted. That's also why the BRICS membership seems to go up every week, every quarter, new members. That's why 45 nations are trading outside of the U.S. dollar. These were considered sensational headlines when we warned about them, including Andy back in 2022. Everyone thought it was hype. De-dollarization is not going to make an edge. The U.S. dollar is still king of liquidity. It's 85% of FX transactions. It's the key to the derivative markets. It's the key to the Eurodollar markets. These are all true, but that doesn't change the fact that the dollar may be king in liquidity, but as a reserve asset, as a store of value, as a savings asset, the dollar is no longer king. Gold is king. That is not the bias of a gold bug, whether I'm in Switzerland or in the U.S., whether you're trading from London or you're in the New York or COMEX or the LBMA. The BIS is telling us, and the central banks in the East, which are buying gold at record levels and dumping U.S. treasuries at record levels, are telling us that they don't trust the U.S. Treasury as much as they do gold as a savings asset, as a reserve asset. And again, those who thought that was a sensational comment about de-dollarization and the rise of the BRICS and the rise of trade settlements outside the dollar said it still can't replace the king dollar. I've never said it had to replace the dollar. The dollar's not going to be replaced. The yuan or the ruble or the rupee or the real are not going to be the next world reserve currency. What it does mean, though, is the dollar won't be replaced. It's being repriced. And we see that consistently now. The fact that the COMEX is no longer having open positions, but they're taking actual delivery. The fact that there is less and less, segregated, allocated gold and silver for the COMEX banks, the LBMA banks to manipulate the gold price is not a coincidence because nations want their gold at home. They don't want it on these exchanges. They don't trust these exchanges. That gives those exchanges less power to manipulate the gold price. The repatriation of gold in 30 countries in the last year and a half is not a coincidence. The oil trade is not a coincidence. That more and more trades outside of the U.S. petrodollar are taking place every day, 20% less than they were the year before. These were unthinkable things. Even the Shanghai Exchange is growing. You can't have a moving day average on the Shanghai Exchange that is different than the U.S. than the other exchanges. So you're going to have to price gold more fairly. Shanghai has changed the chess pieces on the board. And finally, even the IMF, of which I'm no fan, and central bank digital currency, of which I'm no fan out here in Europe. Well, even their central bank digital currency, to have credibility, has to have some reconciliation with gold. They've said that. So all of these signs, which are way beyond just my conviction / bias or Andy Schekman's or Ronnie Sturfula's or Luke Roman's or anyone else's.
During the interview, MatthewPiepenburg mentioned the recent rate cut was expected as the Fed faced pressure to choose between the dollar and the bond market. He notes that refinancing $15.5 trillion in U.S. Treasuries at higher rates is unsustainable. Treasuries are ending the week at higher yield levels after the first Federal Reserve interest rate cut in 4 years. While Wednesday's half-point rate cut was larger than the quarter-point cut many market participants expected, note and bond yields reached their lowest levels of the year in the days leading up to it. That left the market with little scope for gains, particularly as the outlook for future rate cuts remains murky. Despite claims of economic strength, he notes that while there may be disinflationary moments, the long-term trajectory is inflation and a weakening dollar to monetize growing debts. Let's get back to the interview.
I'm not alone in this. This was hardly a nail-biter rate cut for a lot of us and for many. At the beginning of the year, there was talk of 6 rate cuts when the Fed kind of forward guided that at the end of 2023 and into 2024. And that was the big talk at the conference I was at in Vancouver in January. I said I thought it would probably be July or September. That doesn't mean I'm a genius. I just knew there'd be delayed and the rate cuts would come. I've been wrong on rate cuts. I thought there might have been a rate cut in 2023 when we had the banking crisis, and that didn't happen. But this one, for many, really wasn't a shocker. Nothing happened in July, and so by the time September came along yesterday, many were saying it would probably be 50 basis points, which is exactly what it was. I think in a lot of ways the markets have priced this in. I think the implications of it are far more obvious and far more predictable. It was always a matter of when, not if, the Fed would have to pivot toward rate cuts because it was a choice between saving the dollar and saving the system, and the system is the bond market. And the bond market really is the Fed's real mandate, not employment and inflation, in my opinion. And so there's a number of reasons why this was simply inevitable. Again, not a nail biter. At the end of the day, the dollar had to be sacrificed for a number of reasons. One of the most obvious, Dunnigan, is just the fact that there's about $15.5 trillion in U.S. Treasuries that have to be rolled over in the next 3 years. And that's a lot of money in a short period of time that has to be refinanced at the government level for Uncle Sam. And, the coupon, which is the sticker price for those treasuries, had an average weight of about 2%, 2.3%. But because of the higher for longer policy under Powell and the raising rates and the price pressure that put on bonds, the actual true interest expense, the yield, was 5.3. So that's double the coupon. So that's an expensive and painful bill. The Uncle Sam literally couldn't afford Powell's policies. So this rate cut was, again, somewhat inevitable. It was really too expensive for Uncle Sam. It's also too expensive for foreign markets and everyone else. But, it's also, I think, then again, the pivot to the rate cut and the soon-to-be pivot from QT to QE is just Powell's way of admitting, without saying it out loud, that his war on inflation was lost. We didn't hit target 2%. They may have retargeted inflation for 3%, and that might have saved a little face. But look, to your point, if things are going so well and the markets are great and labor is great and employment's great, why do we need a 50 basis point cut going into an election cycle at the end of the year? Not a huge shocker, but it's the classic bipolarity of what the Fed does versus what it says. Fed is just as political as any other branch of the four branches of our government now. You can't listen to what they say. You look at what they do. And frankly, throwing in the towel and cutting rates when higher rates was supposed to be the fight against inflation, and throwing in the towel before they hit target inflation was just their way of saying America can't afford rising rates to fight inflation. We couldn't do it much longer, so we caved. But inflation, as I've said many times, is the end game no matter what. If they kept rates higher and didn't cut, we still would have had inflation, because that's the classic fiscal dominance argument that if you raise rates too high, then Uncle Sam's bar tab gets higher and higher. And the only way to pay for that is to print more money, which is inflationary. And if you don't raise rates and you cut rates, well, that is also inflationary. And so this really is damned if you do, damned if you don't. Inflation's here to stay. That doesn't mean we can't have disinflationary or even deflationary moments if the markets mean revert, even though they're effectively subsidized by the Fed. If markets mean revert, or we have and we are going to be, and I think we're already in a recession that is highly disinflationary, and raising the Fed funds rate from 0 to 5.25 or 5.25 plus in a short amount of time is inherently deflationary or disinflationary. But the end game will always be, we're in debt up to our ears. We're going to have to cover the delta between tax receipts and GDP, which isn't enough, with something that will be money mouse clicked out of nowhere, and that is inherently inflationary. So we can have disinflationary, deflationary moments, but America is looking a long road of inflation, weakening dollar to cover and monetize our debts.
As more nations shift toward gold and diversify away from the dollar, the global financial landscape may continue to evolve, leading to a multipolar reserve system. Do you believe the dollar will maintain its status as the world's reserve currency? Or will we see a new global financial order driven by gold? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.